Ever feel like the Indian stock market is just overwhelming? You hear about it, maybe you're thinking, hey, how do I build wealth? But figuring out step one feels huge. If that's you, well, this deep dive should help.
Yeah, definitely. We're going to break down the Indian stock market today, really focusing on the basics. We've got a beginner's guide here, and our mission basically is to pull out the key stuff you need to know without, making your head spin.
Okay, great. So let's start right at the core. What is the stock market, fundamentally?
Think of it simply as a big marketplace. It's where people buy and sell tiny pieces of ownership in different companies. These pieces, you'll hear them called shares or stocks or equity. Same thing.
Right. And when a company first offers these shares, that's different, isn't it?
Exactly. That happens in the primary market. That's when a company does an IPO, an initial public offering, to raise money. After that initial sale, the shares then trade between investors like you and me.
And that happens in the secondary market.
Precisely. That's where most of the day-to-day buying and selling goes on.
Got it. Now, in India, there are two main places this trading happens, the big exchanges.
That's right. You've got the Bombay Stock Exchange, the BSE, and the National Stock Exchange, or NSE.
BSE, that one sounds old, like really old.
It is. Asia's oldest, actually. Set up way back in 1875. Can you believe that?
Whoa.
Its original name was the Native Share and Stockbrokers Association.
Wow.
Yeah. And lists a huge number of companies, over 5,300. It also went electronic pretty early, relatively speaking, back in 1995 with a system called Bolt.
Okay, so established, lots of companies. What about the NSE, the newer one?
Right. Founded in 92, started trading in 94. But here's the key thing. The NSE is now the largest exchange in India by trading volume. And, importantly, it was the pioneer of fully automated screen-based trading nationwide.
Ah, so it really pushed modernization.
Absolutely. It brought in a new level of efficiency, speed, and transparency. Most major companies, you'll find them listed on both exchanges anyway.
And they operate similarly day to day, trading times, getting your shares.
Yeah, pretty much. Trading hours are the same, 9:15 per day to 3:30 p.m. Monday to Friday. And the settlement cycle is T+1 now. Buy shares today, they're typically settled in your account the next business day. Both use electronic systems, so it's anonymous and transparent.
Okay, makes sense. But who's watching over all this, making sure it's fair?
That's SEBI, the Securities and Exchange Board of India. It was officially set up with powers in 1992, same time the NSE was getting going.
And its job is?
Its main goals are protecting investors like you, helping the market grow and develop, and regulating everything. Setting rules, ensuring integrity. The early 90s were really transformative, getting SEBI established and the NSE bringing in modern tech. Big shift.
Okay, exchanges regulator. Got it. How do we actually track how the market's doing overall, like a temperature check?
Right, that's where indices come in. Think of them like barometers. They measure the performance of the whole market, or maybe just a specific part of it. Good for benchmarking.
And the two big names everyone hears are Sensex and Nifty.
Exactly. The Sensex, or S&P BSE Sensex, technically is the main index for the BSE. Launched in '86, tracks 30 large, well-established, actively traded companies across key sectors. It's kind of the old guard, giving a broad sense of the economy.
And Nifty.
That's the Nifty 50, the flagship index for the NSE, launched in '96. It includes 50 of the largest and most liquid stocks, often called blue chips. It covers a really big chunk of the NSE's total market value, maybe 55–65%. So it's a very comprehensive indicator. Both get reviewed twice a year, June and December.
How do they figure out which companies are in and how much they count?
Good question. They both use what's called the free float market capitalization weighted method.
Okay, write that down. Market capitalization is?
Just the total market value of all a company's outstanding shares, price per share, times the number of shares.
And free float.
That means they only count the shares that are readily available for trading by the public. They exclude shares held by promoters, the government, or strategic investor shares that aren't really expected to be sold on the open market.
Ah, I see. So it reflects the part of the market investors can actually buy into.
Exactly. It gives a much more accurate picture of the investable market compared to the old full market cap method they used to use years ago.
Yeah.
Both Sensex and Nifty switched over. Sensex in 2003, Nifty in 2009.
Makes sense. Okay, let's switch gears slightly. There's a lot of jargon, lingo in the stock market world. What are some absolute must-know terms for a beginner?
Okay, yeah, let's hit a few key ones. We've mentioned share stocks equity. That's your ownership piece.
Yeah.
Dividends, that's if a company decides to share some profits with shareholders. Not guaranteed, though.
Right.
Bull market means prices are generally rising. lots of optimism. Bear market's the opposite, prices falling, pessimism. Market capitalization, we just did the company's size. Volatility is important, how quickly and how much prices jump around. It's a measure of risk,
The
really.
higher volatility, more risk.
Generally, yes. Then there's liquidity, how easily you can buy or sell a stock without massively impacting its price. High trading volume usually means high liquidity. Bid and ask price. The bid is the highest price a buyer is willing to pay right now. The ask is the lowest price a seller is willing to accept. The difference between them is the bid-ask spread, sort of a hidden cost of trading.
Ah, okay. And finally, the broker.
Yep, the broker is your intermediary. They're registered with SEBI, and you need one to actually place your buy and sell orders on the exchange.
That point about liquidity and the bid-ask spread seems really crucial, especially for someone starting out.
Oh, absolutely. Higher liquidity is usually better for beginners. It generally means the bid-ask spread is tighter, so you lose less just getting in and out of a stock. And high liquidity often means lower volatility, too. It's just easier, less friction. Contrast that with, say, some penny stocks, very low liquidity, wide spreads, prices can jump wildly. Much riskier territory for newcomers.
Right. So understanding liquidity helps manage risk and cost. Okay, wow. We've covered the basic structure, the exchanges like BSE and NSE, the regulator SEBI, those key indices, Sensex and Nifty, and some essential terms. Hopefully this gives you, the listener, a much clearer starting point.
Yeah, the goal wasn't to make anyone an expert overnight, but to demystify it a bit. Understanding these fundamentals is really that first step towards feeling more confident.
Yeah, absolutely. So to leave you with something to think about, we talked about the BSE's long history and huge number of listed companies versus the NSE's focus on technology and high trading volume. If you're a beginner just starting your research, what's maybe one factor you might weigh when deciding whether to initially focus more on companies predominantly on BSE or those leading the charge on NSE?
That's interesting. Well, perhaps you might consider your own risk appetite. Are you looking for potentially less volatile, maybe older companies, which might be more numerous on BSE's broader list? Or are you drawn to the potentially more dynamic, definitely more heavily traded large cap stocks that dominate NSE activity? There's no single right answer, but thinking about that difference could guide your initial exploration.
Good food for thought. Well, hopefully this deep dive has helped map out the territory of the Indian stock market a little better for you. There's always more to learn, of course, but now you have a foundation. Keep exploring.
I've included links with more details in the description below, so be sure to check those out. And while you're at it, don't forget to subscribe to our channel, Deep Dive, like the video, and ring the bell for more helpful content. Thanks so much for watching, and have a great day ahead.